Hook. Derek and Priya graduated from the same computer science program on the same day in 2019. Same GPA, same interview circuit, same stack of competing offers sitting on the same dorm room desk in the final week of April. Derek took the highest offer, $145,000 at a tech company in San Francisco. Priya took $95,000 at a tech company in Austin, Texas. Everyone in their graduating cohort assumed Derek had made the smarter financial decision. The $50,000 gap made the logic feel airtight. It is now 2024. Derek earns $175,000 after 5 years of raises. Priya earns $115,000. In gross salary, Derek has earned approximately $300,000 more than Priya over their entire working careers to date. Here's the thing. Priya has $50,000 more in investments than Derek. Higher net worth, more saved, more building. She has been the one falling behind on paper for 5 years, and she is ahead where it counts. Derek ran the numbers 2 months ago. He did it on a Sunday morning at the kitchen table in the 680-square-foot apartment for which he pays $3,200 a month in rent. It took longer to accept the result than it took to calculate it. The setup. In 2019, the offer comparison appeared simple. $145,000 versus $95,000. Over 5 years, that gap compounds to $250,000 in additional gross earnings for Derek. Every conventional framework for evaluating career decisions pointed toward the higher number. What neither comparison included was the question of what each salary actually produces after the city, the tax code, and the cost of living have all collected their share. Gross salary is an input. Investable surplus, the money left after all obligations, is the output that determines wealth. And these two cities produce radically different outputs from the same inputs. Derek was 24 when he made the decision. He had no framework for the distinction between gross salary and investable surplus. He had a spreadsheet that subtracted $95,000 from $145,000, multiplied by 5, and returned a number that looked decisive. The spreadsheet was doing the right math. It was answering the wrong question. Priya did not use a more sophisticated framework. She used a different instinct. She looked at the rent in both cities before she looked at the salary in both cities. The sequence of that calculation changed the conclusion. Derek in San Francisco. Derek's $145,000 gross produces a monthly take-home of approximately $7,800 after federal income tax, California state income tax, and FICA contributions. California's marginal income tax rate for his bracket is 9.3%, the fourth highest state rate in the country. The federal rate on his top dollars runs at 24%. The government collects nearly a third of each additional dollar Derek earns before he has the chance to make a decision about it. His rent for a one-bedroom apartment in a neighborhood close enough to make the commute reasonable is $3,200 a month. San Francisco grocery prices run approximately 18% above the national median. Transportation, utilities, phone, and health insurance contributions add roughly $700 a month. Dining and social spending in one of the most expensive restaurant markets in the country add approximately $600. His total monthly expenses, approximately $5,900. Monthly investable surplus, approximately $1,900. Here's the thing. That $1,900 is the number that actually matters, not the $145,000 on the offer letter, not the $7,800 take-home. The $1,900 per month that is actually moving towards something is the only number that compounds. Over 5 years at 7% annual return, Derek's $1,900 monthly investment builds to approximately $136,000. Priya in Austin. Priya's $95,000 gross in Austin produces a monthly take-home of approximately $5,800. Texas has no state income tax, 0%. The federal rate applies at the same brackets, but the full absence of state tax creates a meaningful difference that compounds annually across an entire career. Her rent for a comparable one-bedroom apartment, equivalent square footage, equivalent commute distance, equivalent building quality, is $1,450 a month. Austin's overall cost of living runs approximately 15% below the San Francisco metro area. Groceries, utilities, transportation, and insurance add approximately $550. Dining and social expenses add approximately $450. Total monthly expenses, approximately $3,200. Monthly investable surplus, approximately $2,600. But here's what. Priya earns $50,000 less per year. She has collected $250,000 less in gross compensation over 5 years. She has also built $50,000 more in investment assets than Derek over the same period. The city absorbed a salary premium that the offer letter never disclosed was going to happen. Over 5 years at 7%, Priya's $2,600 monthly investment builds to approximately $186,000. $50,000 more than Derek's portfolio on $50,000 less annual income. The taxes nobody discusses. The California versus Texas tax comparison deserves its own accounting because most people discussing salary differences do not include it. Derek's California state income tax on $145,000 is approximately $11,700 annually, close to $1,000 per month that Priya simply does not pay. Over 5 years, that is $58,500 in additional tax paid by Derek relative to Priya for the same federal obligations. That amount, invested at 7%, would have become approximately $83,000 by year 5. The marginal rate matters as much as the effective rate. Every dollar Derek earns above his current bracket is taxed at the combined federal and California rate of approximately 37 to 40%. Every dollar Priya earns above her bracket is taxed at the federal rate alone, approximately 22 to 24%. When salary increases arrive, Priya keeps a meaningfully larger share of each additional dollar. And here's the part. State income tax is not a variable most people include in the offer comparison spreadsheet. It is a fixed annual cost that applies to every dollar earned, every year, for as long as the person lives in the state. On a $145,000 income, it is not a footnote. It is $1,000 a month. The comparison. The number Derek calculated on that Sunday morning was not $50,000. He already knew it was $50,000 per year. The number that stopped him was the net position. 5-year gross salary advantage for Derek, $250,000. 5-year investment portfolio advantage for Priya, $50,000. The net cost of the San Francisco premium over 5 years, $300,000 extracted by the city from what should have been Derek's wealth. That is $60,000 per year, $5,000 every month. The difference between what the offer letter implied Derek was earning more than Priya and what Derek actually built more than Priya is $300,000 over 5 years. The city charged $5,000 per month for the privilege of earning at San Francisco rates. Here's the thing. The salary felt real at every point in the 5 years. Every direct deposit, every conversation where Derek described his income, every moment where the $145,000 felt like evidence of a correct decision. The $5,000 per month extraction was invisible in the same way all percentage-based, automatic recurring costs are invisible, spread across 1,000 individual transactions, never registered as a single decision. The counter-argument. The case for San Francisco is real, and it deserves honest treatment. San Francisco's tech ecosystem produces career growth, network access, and equity compensation upside that Austin does not replicate at the same density. Derek's company offered equity grants, 15,000 shares vesting over 4 years at a strike price of $28. If the company's valuation holds and Derek exercises intelligently, those shares represent potential upside that does not appear in a monthly surplus comparison. The career optionality produced by being embedded in the densest concentration of tech employers, investors, and senior engineers in the world is also a real asset. But here's what. Most people who accept San Francisco's cost of living premium are not choosing it for the equity upside they have calculated. They are choosing the gross salary number because it is larger. The career growth argument is frequently a post hoc justification for a decision made on the basis of the offer letter alone. Derek did not model the equity strike price probability or the tax consequences of exercise. He compared two gross salary numbers, circled the larger one, and called it a financial decision. The equity may make Derek right in the end. The equity was not in the spreadsheet. What the salary actually buys. Here is the question that almost no one asks before accepting an offer. What does this salary actually purchase after the city? The state and the cost of living are finished with it. Gross salary is the number on the letter. Net salary is the bank deposit. Investable surplus is what remains after the full cost of operating in that city. These three numbers are not the same number, and in high-cost cities with high marginal tax rates, they diverge significantly. Most career decisions only compare the first one. A $145,000 salary in San Francisco produces approximately $1,900 monthly in investable surplus. A $95,000 salary in Austin produces approximately $2,600 monthly. The Austin number is larger. It is larger on $50,000 less annual income. The surplus comparison inverts the salary ranking entirely. And here's the part. The math does not require a move to Austin specifically. It requires a calculation. A person can stay in San Francisco, having run the numbers and decided the equity, career trajectory, or lifestyle is worth the cost. What most people cannot do is stay in San Francisco having never run the numbers. Assume the higher salary means they are winning the financial comparison, and be correct. 3 things. The reason chasing a high salary is often the wrong optimization target comes down to 3 things the gross number does not capture. First, salary is taxed at the margin, not the average. The $50,000 difference between Derek's and Priya's salaries is not taxed at their average rates. It is taxed at the marginal rate that applies to the top dollars earned. In California, combined state and federal marginal rates for Derek's income level approach 37 to 40%. The $50,000 gross premium delivers approximately $30,000 in after-tax income before a single cost of living dollar is spent. The offer letter shows the gross. The bank account receives the net. Second, cost of living differences apply to the entire budget, not just the salary premium. Derek's housing cost is $1,750 more per month than Priya's, $21,000 per year. That is not a cost that scales with salary. It is a fixed charge the city applies regardless of income level. A $95,000 earner in San Francisco pays the same $3,200 rent. The higher salary does not offset the higher cost. It is consumed by it. The city charges the same admission price to everyone. Third, high salaries anchor lifestyle expectations in ways that compound over time. A $145,000 salary in San Francisco comes with a social environment priced at that income level. The restaurants, the activities, the apartment quality that feels normal at $145,000 in San Francisco would feel extraordinary at $95,000 in Austin. The lifestyle inflation that follows a high salary in a high-cost city is not accidental. It is structural. Opting out requires actively resisting the environmental norm, which most people do not do consistently. Here's the thing. The number on the offer letter is the starting point of the calculation, not the end of it. The ending point is the investable surplus, and that number is never on the letter. The close. Derek is not leaving San Francisco. He is not regretful about his career. The equity is real. The network produced a job change last year that added $30,000 to his salary. The things that San Francisco promised have largely delivered. What changed is the variable he is optimizing for. He tracks the monthly investable surplus now, the actual number that is compounding toward something. He negotiated remote flexibility to reduce transportation costs. He spent 3 months on the waiting list for a better-priced apartment 2 neighborhoods over. The gross salary stayed the same. The surplus increased. Priya did not make the smarter career decision. She made a different first calculation. She looked at the rent before she looked at the salary. She asked what the city would charge before she asked what the company would pay. The sequence of those questions changed everything about what the comparison meant. You already know what city your salary is operating in. The question is whether you have ever calculated what that city charges you per month for the privilege of earning there, and whether what remains is the number you think it is. This is what we do at Vaulted Finance. The kind of money math that doesn't make the headlines but quietly decides how the next 30 years of your life actually play out. New breakdowns drop here regularly, so subscribe if you don't want to miss the next one. And drop the topic you want to break down next in the comments. We're reading, and the most requested ones are the ones we cover first.